Home prices in some of America's most famous mountain towns are falling fast, but the cost of owning those homes is exploding. Insurance premiums are surging, HOA fees are swallowing paychecks. Properties are sitting unsold for months, not because they're overpriced, but because buyers have vanished. The dream isn't just cracking, it's turning into a liability. If you own property in places like Aspen, Vail, or Breckenridge, this downturn isn't theoretical, it's personal. Prices are sliding, costs are rising, liquidity is disappearing. So here's the question no one wants to answer. Which Colorado mountain towns are making homeowners poorer, even as homes get cheaper? This downturn does not look like the last one. There is no wave of forced selling, no sudden flood of foreclosures, and no single shock that can be blamed and moved on from. Instead, what is happening across the United States, especially in resort and mountain markets, is a slow collapse driven by disappearing demand. Interest rates changed everything. When borrowing costs doubled, the buyer pool didn't shrink gradually. It broke. Buyers who once stretched into second homes, vacation properties, and short-term rentals simply stepped back. At the same time, sellers refused to move. Millions of homeowners are locked into mortgages below 3%. They are financially frozen, unwilling to sell, even as prices fall. That stalemate has drained liquidity from the market. At the same time, the migration trends that powered the pandemic boom have reversed. Zoom towns were built on the assumption that high-income remote workers would keep arriving forever. That assumption failed. Offices reopened. Corporate pressure increased. The pool of cash buyers thinned out. Demand didn't shift, it vanished. Then came the structural stress that prices alone cannot fix. Across the country, cities and counties moved aggressively to rein in short-term rentals. Caps, moratoriums, and new taxes stripped away the income streams investors were promised. In parallel, insurance costs surged, especially in wildfire-prone regions. In some places, insurers stopped writing new policies altogether. Without insurance, mortgages collapse. Without mortgages, markets stall. And even where prices have dropped, affordability has not returned. HOA fees have risen. Property taxes remain elevated. Insurance premiums now rival rent payments. A cheaper home no longer means a cheaper life. In many cases, it means higher monthly risk. This is why this cycle feels heavier than past corrections. Prices are falling, but the engines that once restarted growth are gone. What remains is a market where homes exist, but buyers, workers, and families no longer do. If you want to understand how this plays out on the ground, city by city, stay with us. Like the video, subscribe, and turn on notifications, because the next 7 stories show what this collapse looks like when numbers meet real communities. And the first stop reveals what happens when a town builds far more homes than anyone is left to buy. 1. Silverthorne. For years, Silverthorne was marketed as the affordable alternative in Summit County. While nearby resort towns pushed prices into the stratosphere, Silverthorne promised access. Close to the slopes, close to the highway, and still within reach. That positioning attracted developers at exactly the wrong moment. During the pandemic boom, construction surged. Cheap financing and relentless optimism fueled a wave of condo and townhome projects across town. According to local market data, new construction inventory in Silverthorne jumped by roughly 145% year over year. The assumption was simple. Buyers would keep coming? They didn't. As interest rates rose and investor demand faded, listings began to pile up. Homes that once sold in weeks now sit on the market for 4 months or longer. Nearly half of active listings have already taken price cuts, many in abrupt increments that signal urgency rather than strategy. These aren't cosmetic reductions. They are attempts to find any remaining demand. Policy shifts accelerated the damage. New restrictions on short-term rentals erased the income model many investors relied on. Booking data shows future reservations collapsing by roughly 50%. The promised cash flow vanished almost overnight. But the deeper problem runs below the surface. Local wages in Silverthorne realistically support home prices closer to the mid-$400,000 range. Yet median prices still hover near $900,000. Locals cannot buy. investors no longer want to. That gap leaves inventory stranded. The result is visible beyond the housing data. Population estimates show Silverthorne declining for the first time in 2 decades. Developers are stuck. Recent buyers face negative equity, and the town itself is slowly hollowing out. Silverthorne isn't collapsing because it lost its charm. It's collapsing because it built for a demand that no longer exists. So what happens when supply keeps rising, but the buyers never come back? 2. Crested Butte. Crested Butte built its reputation on restraint. For decades, it positioned itself as the anti-mega resort, authentic, preserved, and deliberately limited. That image worked. Wealthy buyers arrived quietly, prices climbed steadily, and the town avoided the excess seen elsewhere. Then the market tipped up. Crested Butte is not experiencing a dramatic price crash. It is facing something more dangerous, a complete freeze at the top. Sales volume has fallen by roughly 60%, while transactions above $3 million have dropped by nearly 80%. High-end homes are not being discounted aggressively. They are simply not selling. Listings now sit on the market for 6 to 7 months on average. Nearly half have already reduced prices despite local brokers insisting demand will return. It hasn't. The most destabilizing force isn't housing inventory, it's insurance. Crested Butte's isolation and wildfire exposure have driven premiums to extreme levels. In one recent case, a $4 million home received an annual insurance quote near $70,000. That cost alone rivals a second mortgage. When insurance becomes optional in theory, but impossible in practice, buyers disappear. Lenders hesitate. Deals collapse before they begin. At the same time, short-term rentals have been frozen by a multi-year moratorium. Investors who once justified high purchase prices with rental income have lost that justification entirely. Without yield and without affordable insurance, luxury homes become liabilities. Crested Butte was built on the belief that scarcity would protect value, but scarcity cannot overcome structural risk. And when even the wealthy hesitate to buy, what happens to a market designed exclusively for them? 3. Steamboat Springs. For generations, Steamboat Springs took pride in being more than a resort. It was a working town, anchored by families, schools, ranches, and essential services. That balance held until the luxury wave arrived. Between 2019 and 2023, home prices in Steamboat Springs doubled. Over the same period, local incomes rose by less than 10%. That gap was never sustainable. It just took time to surface. The first cracks appeared in the condo market. Steamboat is saturated with aging 1980s-era units, many carrying high HOA fees and facing rising maintenance costs. As interest rates climbed and short-term rental taxes increased, investor demand evaporated. Condo inventory surged by more than 120%, while average prices fell roughly 25% from their peak. Units that sold near $900,000 now struggle to attract interest closer to $650,000. But the deeper collapse is social, not financial. Families began leaving. School enrollment dropped by double digits in a single year. The local hospital declared a staffing crisis, not because workers were unavailable, but because they could not afford to live anywhere near their jobs. This is what happens when housing costs detach from local wages. Single-family home sales have fallen sharply, but the middle of the market has vanished entirely. What remains are untouched luxury properties on one end and depreciating condos on the other. Steamboat Springs didn't collapse because tourists stopped coming. It collapsed because the people who made the town function were forced out. And when a community loses its workforce before prices fully reset, can the housing market ever truly recover? 4. Breckenridge. Breckenridge represents the peak of Colorado's mountain tourism machine. Millions of visitors each year. A storybook Main Street. A global brand built on skiing, rentals, and constant demand. For a long time, owning property here felt risk-free. That confidence is gone. The collapse in Breckenridge is not subtle, and it is not accidental. It is the direct result of aggressive short-term rental regulation. In an attempt to address housing shortages and community strain, local authorities imposed some of the most restrictive STR policies in the country. The impact was immediate. Rental revenue in newly restricted zones collapsed by roughly 70%. For heavily leveraged investors, the math broke overnight. Properties purchased for yield suddenly produced losses. The exit doors opened all at once. Inventory surged nearly 90% year over year. Homes didn't just list, they sat. Transaction volume has now declined for multiple consecutive quarters, signaling something deeper than a seasonal slowdown. Sellers are cutting prices, yet homes continue to linger. The damage spread beyond housing. Breckenridge's commercial core is showing visible stress. Dozens of storefronts near Main Street now sit vacant, the highest level ever recorded. Visitors still arrive, but they spend less and stay shorter. Day trips replaced long vacations. Economic support thinned. On paper, median home prices remain high. In practice, buyers are negotiating hard, and sale-to-list ratios continue to deteriorate. What was once a high-velocity market has slowed into something closer to a depression. Breckenridge didn't collapse because demand disappeared. It collapsed because the rules changed faster than the market could adapt. And when regulation removes income before prices adjust, who is left holding the risk? 5. Telluride. Telluride has always been deliberately hard to reach. Tucked inside a dramatic box canyon, it built its mystique on isolation, understatement, and extreme exclusivity. For years, that scarcity justified prices that seemed untouchable. That assumption has broken. The collapse in Telluride is concentrated at the very top of the market. Sales of homes priced above $5 million have fallen by roughly 85%. Listings in the 5 to 10 million range have surged, while average time on market now approaches 10 months. These are not distressed properties, they are simply unwanted. The buyer profile that once sustained Telluride has changed. Tech executives are no longer working slopeside full-time. Private jet traffic has shifted to newer luxury destinations. And with comparable budgets, buyers now choose modern inventory elsewhere rather than aging properties with mounting risks. Those risks are no longer abstract. Wildfire exposure has pushed insurance availability to the edge. Major insurers have paused issuing new policies in the area, and without insurance, financing becomes impossible. Cash buyers hesitate. Lenders retreat. Transactions stall. Meanwhile, the cost of daily life has reached absurd levels. Basic goods cost multiples of national averages. Service workers are bussed in from hours away, turning Telluride into a place that functions without a permanent workforce. Census data shows the town aging rapidly as full-time families disappear. Telluride has become visually perfect and economically fragile. A luxury enclave with no liquidity is not a safe haven, it is a locked vault. And when even the wealthiest buyers refuse to unlock it, what happens next? 6. Vail. For decades, Vail represented certainty. Owning property here was considered one of the safest bets in resort real estate, protected by global prestige, steady tourism, and limited land. That certainty has eroded. Vail's breakdown is not being driven by a lack of interest in skiing or lifestyle. It is being driven by ownership costs that no longer make sense. In Vail Village, average HOA fees have climbed beyond $2,000 per month. That is $24,000 a year before mortgages, property taxes, insurance, or renovations are even considered. Buyers are doing the math and walking away. Transaction volume in Vail Village has fallen sharply, with many listings sitting for 6 months or longer. Price reductions are becoming routine, often exceeding 10% just to generate activity. On multi-million-dollar condos, that translates into hundreds of thousands of dollars erased simply to close a deal. The problem is compounded by aging inventory. Much of Vail's housing stock dates back to the 1980s. Renovation costs are no longer cosmetic. Buyers are facing $500,000 upgrades layered on top of already inflated prices and rising monthly obligations. As demand thins, the impact reaches the town itself. Sales tax revenue has dropped, creating a growing municipal budget shortfall. Population data shows decline, not growth. The brand remains famous, but the fundamentals are weakening. Vail is discovering a hard truth. Prestige does not override cash flow, and when ownership feels like a financial drain rather than an asset, Demand disappears quickly. If Vail is struggling under its own costs, what does that say about the market's most iconic name still ahead? 7. Aspen. Aspen was never just a town. It was a symbol. A global shorthand for extreme wealth, exclusivity, and the belief that some markets are simply immune to gravity. For decades, the rule here felt unbreakable. Prices only moved in one direction. That rule is gone. Aspen is now experiencing the most severe real estate reversal in Colorado. Median sale prices for single-family homes have fallen by roughly 32% from their peak. Sales volume has collapsed by more than 60%. This is not hesitation. It is abandonment. Inventory tells the real story. Active listings have surged by over 200%, while homes now sit on the market for 9 months on average. That is not a functioning market. It is a showroom with no customers. The forces behind the collapse are structural. The era of cheap money that inflated Aspen's prices is over. Remote work demand has faded. High net worth buyers are redirecting capital to newer luxury destinations with modern infrastructure and lower friction. The Aspen premium no longer justifies itself. The damage extends beyond housing. With transactions slowing, the town's tax base is weakening. Luxury retailers and galleries are reporting sales declines near 50%. Census data reveals the most unsettling statistic of all. More than 60% of homes in Aspen sit vacant for over 10 months each year. Aspen still looks perfect, but it no longer functions like a living community. It has become seasonal, hollow, and financially exposed. Aspen's collapse is the most dramatic, precisely because belief was strongest here. If the market that was supposed to be untouchable can fall this far, what does that mean for every place that followed its example? Taken individually, none of these towns represent a total collapse of American real estate. Prices are still high by national standards. Streets still look pristine. Resorts still operate. But together, they reveal something far more important. Across Silverthorne, Crested Butte, Steamboat Springs, Breckenridge, Telluride, Vail, and Aspen, the same pattern repeats. Demand surged on illusion, cheap money, remote work, endless tourism, and the belief that scarcity alone guarantees value. When those assumptions broke, nothing solid was left underneath. This is not simply a story about falling prices. It is a story about rising risk. Homes that cost less to buy now cost more to hold. Insurance, HOA fees, taxes, and maintenance have become structural pressure points. Even wealthy buyers hesitate when ownership feels like a monthly liability instead of an asset. The most damaging consequence is not financial, it is social. Workers leave first. Families follow. Schools empty. Hospitals struggle to staff. Communities hollow out long before balance sheets catch up. By the time prices adjust, the people who once justified them are already gone. This is the danger of believing that markets only move upward. FOMO replaces discipline, yield replaces livability, and speculation replaces community. The question now is not whether prices will fall further in these towns. It is whether demand will ever return in the same form. Is this simply a correction after an unprecedented boom? Or is it the beginning of a longer cycle where ownership itself becomes too expensive to justify? If this analysis helped you see the housing market more clearly, like the video, subscribe to the channel, and turn on notifications so you don't miss the next deep dive. And in the comments below, tell us, which town shocked you the most, and where should we investigate next?